Excellent. Well, thank you so much to everyone who is joining us this morning. We're excited to have our guest speaker, which is Rahil, our COO, to be taking us through the financials. So even though us at TradeShield, we do a lot of the legwork around the financials, it's important that you understand what it is that we are doing, what it is that we are looking at. What should you be looking at, especially if you didn't study accounts at school or university, then this is a great way for us to be able to help you to understand what should I be looking for, what does this mean, and how do I use this to my advantage. So I'm going to let Rahil take it away.
Great. Thank you, Amy and Martin, and importantly to all of our attendees. I see there's 88 attendees. I don't know when last I've spoken to so many people. I'm feeling a tad but nervous, I won't lie. But thanks for joining me to go through financials. It's something that I have done previously, and it's something, just for some background, I'm an accountant. I was in the finance space all the way from doing credit control work all the way up to CFO level for 10 years, at which point I decided I wanted to make the shift elsewhere into the operational space. So I'm very well versed in the ins and outs of what it takes to run a finance team and a finance function, and now adding the whole credit mix to it, it's something that I'm grateful that I had the opportunity to do previously. So thank you for joining me. What are we going to be covering in today's session? So we're going to look at how to read audited financials and how are you going to assess affordability and risk. So the main key agenda items is we want to look at what are the key financial statements. I mean, financial statements, particularly of listed companies, can be very large. Financial statements can be over 100 pages. What's key? A lot of that is waffle. What sort of ratios and metrics are important? How do you assess affordability? And how do you identify risk factors? And then lastly, as I've done previously, we're going to go through some real life cases of financials of listed companies. I generally like to pick on the chain stores. So I've got ShopRite and I've got Pick and Pay's financials, which I've always done. And I've decided to add Woolworths into it just to make it slightly different for those of you that have attended previously. So that's what we're going to be covering. If at any point you have any questions, please just drop it in the chat or the Q&A, or put your hands up and we can turn on your mic. And yeah, I'm looking forward to engaging with you guys during the session. So let's jump into it. So what are the key financial statements? So there's three main financial statements that you want to pay close attention to. And it's called your balance sheet, or as it's now currently called, that's the old terminology, it's your statement of financial position. It's your income statement, which is your statement of income, and it's your cash flow statement, and that's largely unchanged, right? So it's called these are the old terminology. I use both the old terminology, which is the balance sheet, as well as the new one, which is the statement of financial position, your income statement, which is your statement of comprehensive income, and then your statement of cash flows is relatively unchanged. These are the main ones. They're not the only ones. I mean, generally, banks say financials would have changes in equity, which you could look at. They'd have lots and lots of notes. They may have a director's report. They may have a chairperson's report. But these are the three main ones that we focus on because we're going to be focusing on the numbers. And so what's your balance sheet, or what's your statement of financial position? Well, it's your snapshot of the financial position of a company at the end of the financial year. So it's at a point in time. So what are your key components? It's your assets, i.e., what does the business own? And those are generally split into your current assets and your non-current assets. Your current assets as your bank account, your inventory, your debtors book, very important for everyone on the call, as well as your non-current assets. So what are your main non-current assets? It's your property, plant, and equipment. It's your right of use assets. It's any loans that you've given maybe to other companies within the group, for example. And you can also have an element of investments, etc., that all sit in your non-current assets. So that's the main part of the assets. Then you have your liabilities. Once again, your liabilities are split between your current liabilities and your non-current liabilities. Generally, the difference between it is your current liabilities is what you would need to pay in the short term, i.e. in this current financial year that you would need to repay. And the most common things that you would find in there that make up the bulk of that, it's your trade and other payables, i.e. your creditors. And it may be short-term loans or tax liabilities or short-term provisions that would sit in your current liabilities. Your non-current liabilities, generally your loans and your borrowings, and that can either be to financial institutions such as banks or to group holding companies. And then lastly, last but not least, is equity. So that is the ownership of the business in essence. It's what's the share capital, what's the retained earnings. And the simple formula of how this all balances is that your assets in your financial statements equal your equity plus your liabilities. And that's then how the financial calculation works. Now, that is at a point in time, like I mentioned. The next financial statement we're going to be looking at is your income statement or your statement of comprehensive income. And that shows your financial performance over a period of time. So think about it this way. So when you open your wallet right now and you've got the cash that's in your wallet, that's the balance sheet. It's a snapshot of your financial position. But your income statement is from the time you got paid up until today, all of your earnings, all of your expenses, that's the snapshot of your financial performance over a period. And your key components there is your revenue, which is your earnings, it's your expenses, and then obviously it's your net profit, your gross profit. Those are all good indicators. That's quite important. Cash flow statement also very important, especially when you're looking at affordability and you're looking at can I grant them more credit? Are they good to pay me? That shows basically your cash inflows and outflows, and those can be via various ways. The most prevalent would be from operating activities. You are an operating entity. You sell goods to your customers. They pay you for those goods, and you buy goods from your suppliers and you pay them. Those are cash flows from operating activities. There's also others, investment, both investments coming in as well as investments going out, as well as financing activities. Generally, finance activities are those coming in, i.e. loans that you're taking, but it's also interest, for example, that you pay on loans. So those are the three main financial statements. Statement of financial position, or called the balance sheet, statement of comprehensive income, called the income statement, and the cash flow statement, which shows how cash has moved in and out of a business. So you've got some financial ratios and metrics. So what are the important ones? So you have your liquidity ratios. Your liquidity ratios basically speak about how can a business repay its debts in the short term. How liquid is a business? And there's two main ones, and the most common of which is your current ratio, which is your current assets to your current liabilities. If I had to pay all of my current liabilities within the next 30 days, do I have enough current assets to cover that? And generally, anything that is above 1 is considered healthy, but you want to be around 1.2 upwards, so that you know that the business can, in the short term, can pay off its short-term obligations with what it has in its current assets, which is mostly your trade and other receivables, as well as your cash and cash flow equivalents, as well as your inventory as well.
Rahil,
quick ratio, it's basically
before
it's a current. Go ahead, Amy.
Before you move in, so if it was the opposite way around, where the ratio was below 1, would you then consider this business now either in business rescue or, like apply for liquidation?
Not yet, but that would be an indicator of a business that could be moving into distress. So very common that it happens at the current assets, because remember, your current assets, it's your statement of financial positions, it's a snapshot. It could be at that point in time that the current liability is just greater than the current assets. But what you want to do is you want to definitely keep track of how that current ratio is moving over a period of time, from last year's financials to current year's financials. And that could be an indicator of whether the business is in distress or likely to head into distress.
So it's not a matter of, like, let's say, for example, and I'm sure you'll get there, when revenue is less than it was the year before, it may impact that ratio as well, potentially.
No, it's one of those. So, for example, a business that has a drop in revenue, a drop in GP, gross profit, and a drop in total profit, bottom line profit, and has got a drop in current ratio, i.e., their current assets are less than their current liabilities, and that has happened for 2 or 3 years, that is a business that is likely in trouble, or it's a business that needs a turnaround strategy quite quickly. So definitely there's a couple of indicators. I won't say that there's one hard and fast rule. If anyone's got a current ratio of less than 0.5, for example, that is probably a very dangerous place to be in, and you would probably take note of that. But it's not uncommon to see current ratios in the region of 0.8 to 1, even in healthy businesses.
Awesome, thank you.
Great question, Amy. So then there's also profitability ratios, and the two most important ones, at least I believe, but for the purposes of today's discussions, is your gross margin, which is your revenue less your cost of sale, and your net profit, okay, which is after all of your expenses, your cost of sales, as well as your operating expenses, what is your net profit? Usually called your EBITDA, which is your earnings before interest, taxation, depreciation, and amortization. How is the business performing after all of its expenses, before tax, before depreciation, and before amortization? And then moving into your leverage ratios, what's your debt to equity ratio? So how much debt does this business have versus their equity? And that speaks about the gearing of a business. A business that is highly geared has got a high debt to equity ratio, and that's not good. A business that is lowly geared has got a lower debt to equity ratio. So if you have a business with the debt to equity ratio of 2, for example, it means that the debt in that business is 2 times what the shareholders' equity in that business is. And that's generally, you want to keep that lower, around the 1 mark. And then lastly, your interest coverage ratio. So many long-term loans, you don't need to pay back the loan immediately, and that would sit in your non-current liabilities. However, you still need to pay the interest on that. So even though you may not be able to pay the full loan back in the next year or in the next 2 years, you have to be able to cover the interest on that. And that is also something that you can look at when gauging financials, which is the interest coverage ratio, which is your EBIT, your earnings before interest and taxation, divided by your interest expense, and how many times is the business able to cover that interest. So those are your main financial ratios and metrics. We are going to look at some of these a little bit later in the example. So how do you assess affordability? Remember, there's the various C's of credit, the 5 C's of credit, sometimes the 7 C's of credit. There's 2 main elements that I want to focus on today. The one is character, and the other is capacity. Character speaks to my desire to want to pay, and my capacity speaks to my ability to pay. I may have a very thick wallet and able to pay my debts on time, but I don't pay them on time. I generally pay them late. That speaks about my character of being a late payer, but I don't have capacity issues. Alternatively, I may always pay on time, but I'm always on the brink. I'm using my overdraft, my cash flow, my cash flows are generally quite low, my cash and cash equivalents, and that then is the reverse. It speaks about someone with a good character but a lower capacity. Now, how do we solve for this in TradeShield? Is we've got 2 main risk scores. We've got a payment risk score and we've got a default risk score, and they evaluate similar things at different periods of time. Our payment risk score is how likely is this company to pay you within terms. So if you've given them 30-day terms, how likely are they to pay you within those terms? The default risk is how likely is this debt to go into protracted default, i.e. 90 days plus, 120 days plus. And those are your main 2 that speak to character and capacity. I want to pay you, but I can't pay you. That could have a low payment risk, but a high default risk. Or I can pay you, but I choose to pay you late. That could have a high payment risk and a lower default risk. Or someone who's constantly on the brink. I'll always pay late because cash flow is a problem, and I'm a highly geared business, could have both high payment risk and high default risk. And it can go the other way as well. A company that's got good cash reserves, always pays on time, will have a low payment risk and a low default risk. Those are really your four main drivers in terms of risk. So how do you evaluate affordability, and what are the insights that you can get? So from your statement of comprehensive income or your income statement, it's you want to see consistent revenue growth. And the key word is consistent. I mean, you will see that sometimes businesses have a dip, and we saw that in COVID. In COVID, most businesses took a knock in revenue. It doesn't mean that's a bad business, not necessarily, but you do want to see a consistent revenue growth that is showing that the business is growing their top line revenue. We'll see that in the examples a little bit later. You also want to see that profit margins are stable. Every business owner, every investor wants to invest in a business whose revenue is growing and who's turning a profit. And that is also quite important, that there's stability. You don't necessarily have to be always turning a profit. And most businesses these days generally don't turn a profit. Look at Amazon. I think Amazon posted a profit for the first time a couple of years ago after trading at losses every single year for 20, 25 years. Takealot, for example, is another company that we're all familiar with. I don't think that Takealot's ever posted a profit, because that business, it's not about necessarily generating a profit. It's about showing growth. And so that consistent revenue growth is important, as well as having stable margins. Remember, I don't say increasing margins. I talk about stability. You don't want to see big fluctuations in profitability. So cash flow considerations, you want to see positive operating cash flow, that the business is making more cash than it is spending. And this is where your cash flow becomes quite important, because your income statement and your balance sheet could have aspects on it that is not cash. Cash doesn't flow in or flow out of the business. But you do want to see that cash is steadily flowing into the business more than cash is flowing out of the business, and that they do have adequate free cash flow for reinvestment. So that cash flow can be reinvested in a number of ways. It can be reinvested into additional stock, into additional inventory, and it could be reinvested into other financing activities, i.e. buying additional stores, buying additional businesses, or it can be reinvested in increasing their property, plant, and equipment, refurbishing their stores, for example, modernizing a lot of their processes or modernizing their fleet. And that is what you could also see. So you could have a business that has got a decrease in profits, because maybe they're investing more, and therefore their depreciation costs are higher. But they've increased the value of their plant. They've increased the value of their business, and that is something that should be seen in a positive light. And lastly, debt levels. You want to see that they've got manageable debt load relative to income. They can repay their loans, as well as they've got adequate interest coverage. So those are the main things when assessing affordability. So some of the risk factors, we've spoken about some of these already. So some of the risk factors is low current or quick ratios, and consistently low. Anything below 0.5 is in the current ratio, I would say, is considered quite low, and you'd have to see how that business is tracking over a period of time. Solvency risks, are they highly geared? Does that mean that they have got high debt to equity ratio? And that would be a business that has got more debt than it can afford, is generally what we call an insolvent business. And Amy, to your point earlier, insolvent businesses that cannot pay their loans, generally those are the ones where creditors go and apply for liquidation. They get the business liquidated so that they can at least get some of their money back, or cents to the rand, as it's called. And then other operational risks, are there volatile revenue and expenses? Are there negative trends in profitability? Are there any macroeconomic factors? COVID, for example, during COVID, we saw many restaurants go under because their revenue almost overnight fell down to next to nothing, 80-90% drop in revenue, because people weren't going out, people weren't eating out. And then that's the external risks that we speak about, which is market conditions and the regulatory environment. So these are risk factors that you should be analyzing when looking at financials. So we're going to shortly look at a practical application. So we're going to look at a case study, and it's a walkthrough of sample financial statements. Like I mentioned, we're looking at Pick n Pays, we're looking at ShopRite, and we're looking at Woolworths. Interestingly, the last time I did this session, Pick n Pay's financial results were for the 2024 financial year. And I'll show you guys shortly what that looked like. And since then, they've released their 2025 financials, which for the year ended February 2025. And I'll show you just on Pick n Pay's financials, the turnaround in that business. You guys would have heard in the news, last year Pick n Pay was struggling compared to ShopRite, which was consistently showing strong revenue growth and strong profitability, as well as Woolworths was doing quite well. Pick n Pay was, I won't say they were under siege, but they were definitely going through some trying times. And I'll show you guys in the financials how they seem to be coming out of that. I don't think they're fully through the woods yet. And hence you would have heard less in the news about Pick n Pay being in the trouble that you would have heard about it being a year and a half ago. And then I'll open the floor for questions and discuss any real life examples and experiences that you may have. Before I jump into the practical side of it, does anyone have any questions, comments? Does anyone want to add anything?
I don't see anything in the comment section, but if you'd like, you can raise your hand. We're happy to unmute you. And we only mute you just in case someone accidentally forgets, like I do all the time, and then randomly shout out words. Said like being a mom, it's kind of like being like having Tourette's. You just randomly say things like rice cakes.
Yeah.
But so far nothing. No.
Great. Let's move right ahead then. So, like I mentioned, we're going to look at Pick n Pay versus ShopRite versus Woolworths. And we're going to look at 5 main things. We're going to look at their revenue. We're going to look at their gross profit. We're going to look at their bottom line profit, i.e. their profit or loss for the year. And then we're going to look at 6 things: their current ratio, their non-current assets, as well as their cash and cash equivalents. So let's start with the revenue. As you can see, very good to see as a South African, all of these businesses are showing strong revenue growth. Pick n Pay has grown just under 6%, Woolworths at 6.4%. But interestingly, look at the ShopRite group, 12.1% growth. It's basically, if you added Pick n Pay and Woolworths together, that's what ShopRite's growth has been. Now, ShopRite, by far, you can see from their revenue, by far the largest chain store in the country, the grocery chain store. They've got double the revenue of Pick n Pay and, more than 3 times the revenue of Woolworths. And to still do 12.1% growth is a really, really strong performance. This is on the back of their 2024. They haven't yet released their 2025 financial statements, but I'm very interested to see how what that looks like. Again, GP, once again seeing strong GP gross profit growth across all of the businesses. Pick n Pay 7.3%, a ShopRite 11.7%, as well as Woolworths 2.4%. Apologies, FY25 is not for ShopRite and Woolworths. I should have actually put that in FY24 and shown the FY23, but I will fix that. And then lastly, you'll see profit and loss for the year. I mean, the only Pick n Pay went from a 3.3 billion rand loss in financial year 2024 to a 651 million rand loss, which seems like it's a big loss, 651 million, but from where they were, that's a massive improvement. And we're going to deep dive into their financials a little bit later. But again, ShopRite consistently showing strong profits. Look at that. Revenue up 12%, GP up 11%, and net profit up 5.4%. Woolworths, we did see a reduction, but still strong profits. I mean, just interestingly, look at Woolworths profits in financial year 24. Almost the same profit as ShopRite, with a third of the revenue. So really, really strong showing. Martin?
The question is on Pick n Pay's turnaround. I know that they've cut a huge amount of their losses by closing some of their stores. So it's a little bit of an artificial inflation or change, not necessarily that they're growing and making more money, but it's the way that they're redirecting their business that is also doing this. So in some times in a business, you actually have to regroup and redirect yourself to start making profit and making money. Getting rid of bad accounts, getting rid of bad debtors, and that's what we as Tradeshield want to do. And that is how the results will show in your business when you start moving away from the bad to the good like this.
That's a great comment, Martin. And I mean, Pick n Pay, there's a couple of their stores that they closed down, quite a few, as you mentioned, but they still grew their revenue. And that's exactly what we say at Trade Shield is we want to take you from spending time and spending money on your high risk debtors to rather taking that and investing that in your lower risk debtors. And so in so doing, you can boost your revenue, but you can also boost your bottom line because your low risk debtors are not costing you as much as your high risk debtors are on a consistent basis. Neil.
Yeah, we have a question in the chat, Rahil. It is from Andrew, and he is asking, what are the implications in the main with regards to franchisees when the franchisor go through financial difficulties?
What are the implications in the main with regards to franchisees when the franchises go through financial difficulties? Yeah, that's a great question, Andrew. So, the answer is it's not so simple. And basically, when there is a franchise like Pick n Pay, for example, they go through financial difficulties, there definitely is an impact on the franchisees. There can be brand and market impact. The brand, the reputational damage of that franchisor, it means they could cut back on marketing spend and therefore they could suffer, reputational harm, and that could impact the franchisees. There could be customer confidence, which is dropping. Customers then associate that brand is in trouble and then they switch to competitors. So they're not buying from that store, they're moving elsewhere. And that could affect the individual stores as well as the franchisees. They also could be, you lose a competitive edge. So the franchisees, they could lose access to innovations, promotions, or R&D that they would normally be supported by. There's others as well. There's operational support. Maybe head office is the franchisor is not providing the level of support that they were providing previously, less training, less field visits, less operational assistance, and therefore the franchisee now has to bear the burden of that additional responsibility. And what you generally find in businesses that stagnate is technology and systems tend to stagnate. And when you're a franchisee, generally you use the systems of the franchise. And if they're not spending and they're not investing in those systems, they could stagnate and then become outdated. And so there's a different couple of things. Some financial considerations. There could be supply chain disruptions. Higher fees or levies. The franchisors may then decide to up the royalty fees, for example, which I know that they can't easily do, but that's something that they could look at doing in the longer term. And so definitely there are a couple of things that could happen, Andrew. I mean, we could spend the next half an hour talking about all of the different things that could happen, but the main things are the operational risks, the brand risks, as well as then the financial risks that can be associated as well.
In our world, again, there's one specific thing that I'd like to mention there again, Rahil, is the supplier confidence. Because supplier confidence change, because a lot of people don't disassociate the two from one another. They say, this is Pick n Pay, so this is also Pick n Pay, although this is Martin Petzer Pty Limited trading as Pick n Pay West Coast or whatever. It's a franchisee, it's a legal entity on its own. But the association is, and then all of a sudden supplies become more difficult or more expensive because you don't have that power buying anymore, that bulk buying anymore. And now all of a sudden, your product that you have to buy previously at a reduced cost now becomes more expensive. And when you start putting up the prices, you also lose the confidence in your market, as you just said just now, just purely because confidence of your supplier has reduced. We saw that in Westpac. When Westpac went into business rescue and was sold for 100 million. They are battling. The poor franchisees that are sitting out there in the market are still battling because of the brunt that they received when Westpac went into business rescue.
Spot on, Martin. Andrew, we hope that we've answered your question. Okay, so some of the other that to look out for in these financials. So current ratio, so very interesting. You would see, and Amy, this is to your question, Pick n Pay in the previous financial year had a current ratio of 0.79, and that has moved nicely into 1.11, so positive, greater than 1. that's a really large movement. And we'll look at that a little bit later. Now, Woolworths have moved from a positive current ratio or current ratio of over 1 into 0.92. Does that make Woolworths a bad company? No, it doesn't. I mean, we've seen consistent revenue growth, consistent growth in GPs. Yes, their net profit did come down slightly, but it doesn't mean that Woolworths now overnight have become a bad brand. It just means that there's some movements that may have happened that that we can look at their financials and see why that's happened. Non-current assets. Now, Martin, this is to your point, Martin. All of both Shoprite and Woolworths increased their non-current assets that they hold on their balance sheet. Pick n Pays went down. Now, it could be because of the stores that they closed and etc. And so now, therefore, their property, plant, and equipment, because they would have sold off a lot of that, therefore has dropped. And also, it could have been that they were focusing on consolidation, focusing on consolidating their business rather than going and spending on refurbishment, on stores, etc. And that's what we'll see now. Now, that's not a bad thing, especially when you've seen the turnaround that Pick n Pay have started to show. And if this was a drop in your non-current assets, drop in your current ratio, a drop in your revenue, a drop in your profitability, then I would have looked at that and I would have said, oh, those are 3 or 4 different things that are all dropping and something in the business is not healthy. But having 1 or 2 items that are dropping when the rest of the business looks fairly healthy, that is that are good signs. Cash and cash equivalents. And you can see all of them had drops in cash and cash equivalents, but they've all got strong cash reserves. I mean, Pick n Pay, very, very much stable. Shoprite has seen a decline on cash from cash reserves from 12.5 billion to 11.7 billion, and Woolworths as well. But overall, very strong cash reserves, albeit lower than it has been in previous years. Now, interestingly, I would like us to go and jump into Pick n Pay's financials. Because the question that I had mentioned earlier is, we know that Pick n Pay, what was in the news, that they were struggling previously, or not struggling, but they were going through a bit of a tough time. And what did that look like? So let's go jump right into it. How do I?
It is a little bit small, so I'm hoping that you're gonna. Oh wow! Now it's a little large.
That's actually how Rahil has his phone, because he can't read it.
I was like, let me put on my glasses, and then. Okay, there we go.
This is Pick n Pay's previous financial year, so 2023 and 2024. Now you would have seen that even though their revenue was up, their trading profit reduced from 3 billion to 385 billion. So that would have been a question that would have been asked. Whoops. You look at their bottom line profit for the period. They went from a 1.1 billion in 2023 profit to a 3.1 billion loss in 2024. Second amber flag. If you go and you look further down at their statement of financial position, you would have seen their current assets went from 17.4 billion to 20.2 billion. Good positive movement. But the current liabilities also moved in the same, from 23.5 to 25.7. So current ratio hasn't changed too much, but overall, where you would have seen a big change, you would have seen a change in their cash flows. So their bottom line cash flows, they went from cash and cash equivalents, or it actually moved quite well, but from 2 billion to 5.3 billion. But look at this. Overnight borrowings went from 2.8 billion to 5.2 billion. That shows that this was a business that needed to go and draw down on additional funding to be able to sustain their operational activities. Now, this didn't paint, there's a couple of things that we look at, didn't paint a very good picture in the previous year, and rightfully so, they were in the news. Cut forward to the current financial year, and they've just released these statements not too long ago. It's great to see that they're doing that. You see their revenue, as we've already spoken, was up. Trading profit was up from 405 million to 1.7 billion, 4 times increasing trading profit. And interestingly, even though they posted a loss, it went from a 3.3 billion rand loss to a 651 million rand loss. All positive. Now, it's cut across to their current assets, or to the assets, to the balance sheet. Current assets did dip slightly, and we can see where the dip happened. Largely so that the dip was about 500 million rand, and the dip largely came from the property, plant, and equipment going from 9.1 million to 8.6 million. Now that, if we were to go look at the note, is likely due to some of the stores that they had closed down and some of the assets that they would have gotten rid of. Everything else largely similar, not too many changes. Interestingly, you would see from a cash current assets perspective, also pretty flat. Inventory is up about 400 million, and but no major changes, as well as in the cash and cash equivalents, quite flat. Then you would have seen their current liabilities. This is a great number. Current liabilities went from 25 billion down to 18 billion, and the big drive in that, would have come from, they seem to have paid off those a large chunk of that loan, that borrowings, 4.5 billion down to 850 million. But similarly, you see their current liabilities, that 1.8 billion basically being reduced to zero. So what have they done? They've grown their revenue base. They've dropped their loss significantly, even though they're still loss making. Their current assets has stayed largely flat, but their current liabilities has reduced quite a lot. You would have seen current assets previous year is 20.4 billion versus 25.8 billion current liabilities. That was that low current ratio that we looked at. Versus now, current assets of 20.7 and current liabilities of 18.6 shows a strong recovery in that cash, in that current ratio. If we look at the cash flow statement, let's go look at the cash flow statement. You'd see 5.3 billion and to 5.3 billion, cash and cash equivalents has stayed flat. But look at the overnight borrowings, has gone from 5.1 billion in the previous year to just 300 million in the current year. And so this is, you can see, a strong financial performance on the road to recovery. And this is how they're starting to turn that business around and making sure that they, that they once again becoming the strong brand that they're known for. Now, this financials that you look at are so important for you from an outside perspective to get an under the hood look at what a business is doing. And overall, it looks like everything that Pick n Pay seem to be doing seems to be working out for them. Okay. Similarly, I mean, we can look at Woolworths. Woolworths, you've seen strong growth. You see, even on their current liabilities has not changed all that much. It's just the interest-bearing borrowings has gone up about 1.3 billion, but pretty much everything has stayed quite stable. And even though their current assets have dropped, and the current assets, the main drop has been a drop in their trade and other receivables, as well as their cash and cash equivalents. And that is why you see the current ratio moving below 1. Does it speak about a business that's in trouble? Does not, but it does mean that there were some cash generating constraints that they saw in the past year that they didn't see in the previous financial year. And lastly, I mean, Shoprite continue to perform strongly. You can, if you look at their statement of financial position, current assets going from 54 billion to 62 billion. You can see property, plant and equipment from 16.6 billion to 19.6 billion, shows strong investment in their non-current assets, as well as in their current assets. You see inventory has gone up 3 billion, it's about 12%, and their trade and other receivables also gone up. So overall, a strong move in their current assets. It's about a 2.4 billion rand move. And their current liabilities, it's mostly their trade and other payables that has been affected. Borrowings has gone down, and the current income tax liabilities has stayed flat. So overall, as well as their bank overdraft has gone from 6.6 billion down to 2.9 billion. So even though they owe an extra 7 billion to creditors, their loans to banks and banking institutions has come down. So, once again, strong performance by them. I mean, if you go and look as well, revenue going from 220 million basically, or 220 billion rather, to 246. So very strong results. Once again, very interested to see what their financials look like when it comes out. It'll probably be out later on this year. Their financial year would have just ended now on the 30th of June 2025. So I'm hoping by the end of this year that we'd have them, because I'm keen the next time we do this training session to see once again what the returns for Shoprite would have been by then. And that, ladies and gentlemen, basically brings at least my presentation to an end, and wanting to open the floor to questions. Neil.
I'm going to steal the first question because my mic's not muted. Haha.
Sure.
Okay. So my question is, if a customer's cash and cash equivalents drop severely on year to year, right, so from 24 to 25, is this cause for major concern, or does it just mean they're using less cash in their operations?
Great question, Neil. So, I mean, it's not necessarily a cause for concern. Let's go and look at it. Let's go and look at Woolworths, who seem to have had the most drops. So their net cash and cash equivalents, you can see in the previous year, 2023, was 3.3 billion, and that dropped to 1 billion. So let's go and see why. So we can see that there was about a 1.7 billion rand drop in their net cash inflow from operating activities. So that is something that could be something of concern. But that, coupled with the fact that their revenue has increased, as well as, let's go and have a look at it, their trade and other receivables has stayed relatively flat, won't completely concern me. Okay. If you're going to look at the rest of their cash flow, they've gone investment activities. They've gone and they've invested. Now, even though they've created less cash inflow from operating activities, they've also gone and invested 1.5 billion rand in property, plant, and equipment to expand operations. That shows a business that's using their cash reserves to go and expand their operations in order to generate more revenue going forward. That's a good sign. Okay. And then lastly, you see their net cash outflow from financing activities has gone down from 5 billion to 1.6 billion. Let's go and look at it. Shares repurchased. Okay, they've repurchased some shares in the previous financial year, which they didn't do in the current financial year. It's good. It means they're consolidating as a business. But you look at their borrowings repaid. They've repaid quite a large chunk versus what they've. So the movement in the borrowings that they've raised has been 900K or 900 million. And the borrowings repaid movement has also been about 800 million. So it's basically flat. There's about 100 million rand difference there. But what this shows, it shows a business that has still got sufficient cash reserves. Now they've got a 1.1 billion rand cash reserves. If we look at their trade and other payables, their trade and other payables is about 8 billion. So it's about an 8.125 coverage, but they've still got strong current assets. So I wouldn't be overly concerned about this business.
Perfect. Thank you, Rahil.
It does not seem like there are further questions. Does anybody want to ask a question to Rahil? It could be specifically about it. There we go, Melissa. Let me just unmute you there, Melissa. You can unmute yourself now.
Good morning, everyone. Thank you,
morning.
Trade Shield, for hosting the session. I really appreciate it. My question is just around companies being very hesitant to provide financial statements, especially companies that's not listed on the JSE, that's got publicly available financials. How would you assess a company's performance, or what do we have to go on if we want to onboard a client and assess their financial performance?
Great question. Martin, do you want to take a stab at it?
I certainly will, Rahil. So firstly, what we will do is, if we can, we will mediate between yourself and the guy who doesn't want to supply the balance sheet to you. In most instances, we have the opportunity to view the balance sheet and then make an assessment and make a recommendation to you. And sometimes we even go as far as obtaining the ratios, which we then supply to you. So it doesn't divulge the actual information, the actual figures, but it gives you the ratios. And as Rahil has indicated just now, those ratios do indicate the performance changes in any business very, very well. Let's say we can't get those balance sheets. We try and get bank statements. From bank statements, we can also make an assessment of how good they are in managing their cash, number one. Number two, we can estimate the turnover, so we can establish their spending capability, and their spending capability can also help us making recommendations to you. I can't tell you in the 44 years in credit I've been, how many times salespeople walked into my office and wanted a credit limit of 5 million. But if we look at the balance sheet, the guy's turnover is 10 million. How on Mother Earth can they service that kind of credit limit? I've had a few occasions in Trade Shield where the guys will say to me, Martin, you've only recommended this amount of credit in Trade Shield. Why? And then I say, look at the turnover. If you look at the turnover, they cannot service that kind of credit limit. So that's another thing. But now let's say we don't have any of those. That's where the power of analytics come in. And of course, profiling. So what do we do in profiling? That is where we have none of this information. Profiling says, Martin looks like this, he's going to behave like this. How did we establish that? We took data information of 150,000 companies over a 10-year period. First 8 years, we said, show us those companies that traded exceptionally well, show us those companies that traded exceptionally poor. And what were the common denominators in these companies? Now we said, okay, let's find ones with those denominators and let's see if they perform similar in the next 2 years. And there you go. So now we've established a very good parameter to measure someone on that we have absolutely no information on. But in your instance, and I think your question is based on the fact that companies come and ask for very large credit limits from you, get in contact with us at Trade Shield. Let us send someone there and speak to your new buyer, your new debtor, as whichever way you want to refer to it. And the person that usually speaks to them would either be myself or Louis Lombard or even Rahil. We would then go look at the balance sheet, establish whether or not they can afford and service that kind of credit limit that you are looking at, and we will then make a recommendation to you. Now, right now, we call it, for lack of a better word, an out-of-system recommendation. So the information is not residing in Trade Shield, and it leaves you with the complexity when you have to prove to your auditors, where did you, on what did you base this information? Oh, I based it on the fact that Martin Petzer said give him 5 million. And then they're going to say, who the hell is Martin Petzer? But we are working on that to accommodate you so that we can put in certain information inside Trade Shield in the form of a report that will reflect the change in behavior and the change in trading. And that information then will reflect as to why and based on why you have accommodated your client and given him the credit limit. Did I miss out anything, Rahil? Like to add anything there?
No, spot on, Martin.
I was going to say, just in summary, Melissa, what we often say is either let them send it directly to us because they might be sticky about you not wanting to see it. And alternatively, if they don't want to provide anything, if they still say no, then our recommendation is always put them onto COD and let them prove themselves. At the end of the day, we want to help them and we want to trade with them, but we also don't want to trade recklessly.
I just want to add something to that. Sorry,
yeah.
Let me just say something that is powerful, but there's a question to that. So recently someone came to me and said to me, this guy now wants to increase their credit limit to 10 million. But it is a company that was previously in business rescue. Now this company's now come out of business rescue. This guy just paid 100 million rand for that business. So if he has paid 100 million, it means he's got cash somewhere. And he's got a huge amount of assets now that he has purchased. So that already can serve as collateral to you. So use the collateral as a and assets 6-month period, and we'll give you the 10 million. And then after 6 months, that material bond falls away. Then he has proven himself, and you've had security. That is if you want to move into that line of that. But a guy that can pull out 100 million rand and buy a business certainly somewhere has a lot of value that you give them a small credit limit and month on month start trading them up from that smaller limit as they pay. You will see the performance. If they pay you on time, pay you the amount that they owe you without any queries, without any quibbling, then you can say, okay, in 2 months' time, let's take you from 1 million to 3 million. Then they do that again, take them from 3 to 5 million, take them from 5 to 7 million. And by that way, you trade with your up to where they want to be.
We also have a question in the comments section. I hope that does help you, Melissa, with regards to what we recommend. There is a question that was raised by Lavina, who has said, what happens if the customer doesn't want to even sign your terms and conditions or to even fill out your credit application?
Absolutely.
Yes, go for it.
I would be very hesitant to grant credit to anyone, not hesitant. It would be very reckless to provide credit to anyone who does not want to sign some sort of credit application form as well as terms and conditions. Remember, the National Credit Regulator and the National Credit Act makes it mandatory for them to accept certain terms and conditions on the granting or an application of credit. And you, as a credit, even though you are not a bank and you're not a financial institution, there's certain certain conditions that you need to satisfy that you're not recklessly trading. And so anyone who doesn't want to even complete an application, you just can't give them credit. It's just as simple as that. Lavina's got a hand
allowed
up, maybe.
for Lavina to unmute. Yeah, there we go.
Yeah, Rahil, so I did communicate because obviously Deshan also gave me that feedback as well. And they basically saying to us that we completed a vendor application form, obviously, so that they can onboard us on their side, okay? And then they replied and they were like, no, we're not going to complete your people's online credit application because we just don't do it. I got told that they're part of a big group. And I actually went back because we do have multiple accounts that are all part of that same group. And I actually do have credit apps. So I said to the business manager yesterday, I said, I'm sorry. I said, if the other companies who fall under this group could complete those credit apps, they need to do the same. Because now this customer is basically threatening us to say that, oh, well, if you people won't accept our letter stating that we're part of this group and we don't fill credit apps and this is the credit limit that we want, then we'll just close off the contract and we won't deal with you guys. So I'm getting a lot of pushback from business with regards to that credit app, not that they're not wanting to complete. But yeah, no, I'm standing my ground, and I don't know. They must discuss it. Management can decide what they want to do, but I've basically said no.
Absolutely. So I mean, I think you're well within your right to do that, Lavina. I would be extremely uncomfortable because in the event of non-payment, your recourse is what? You have no, I mean, you'd have to go on the basis of tacit acceptance, the fact that you supplied goods or services to them and they accepted those goods and services. But that for me is not a strong enough case. You know, I definitely wouldn't want to be on the other side. And for me, that's a red flag. You know, anyone that doesn't want to accept or doesn't want to sign off on a credit application form for a credit limit that they want is a red flag for me.
Yeah, and the thing is, it's not even a global company. So we do have global accounts where we've got a global contract in place. So we didn't need a contract to be completed within South Africa because we've got a global agreement with I think there's about 2 other companies. But for me, this one in particular, they're not part of a global organization. There is no global contract in place. So yeah, but I'll see what happens. I'll see what happens.
Please keep us updated. We'd love to see. We'd love to see how that goes.
Yeah,
I was just going to say, at the very minimum, they have to sign terms and conditions because that protects them as well as you.
They don't even want to do that.
No.
The one thing that you've touched on is a lot of times they have a service level agreement. And in most instances, a service level agreement contains terms and conditions. So the one company that I worked with, because they were in the servicing industry, it was either the service level agreement that was signed or a credit application that was signed, either one of those two, because they will both contain the most pertinent grounds on which you agree to give them credit. And that's the important factor. And let me tell you, I've put my foot down, but I've been in credit for 44 years, and I've done what you're doing now many a time. And you know what? At the end of the day, it's your job that's on the line. Let's say you give them credit and they go bad. Now you've got nothing in place. Guess who's going to get fired? Lavina, no one else. Not the sales director, not the sales rep, you. Because you remember that. Always
Yeah.
take it back to who makes the decision, and that's you. You've been appointed, and the company expects you to abide to the credit policy, which says your credit policy. I don't know what your credit policy says. I'm just hoping it says that you are not
Yeah.
allowed to open an account without a signed agreement.
Yeah.
And if that's the credit policy, then that's the credit policy.
Yeah.
Spot
Okay. Thank you so much.
on. Right. Thanks, Lavina. Keep us updated.
Now we'll do. Thanks.
Pleasure.
I see we are at time.
Yes.
James, I don't know if anyone has any final questions.
So far not, but of course you can always reach out to us at support@tradeshield.ai and or use your chat or use the WhatsApp line. So many ways to get a hold of us. I have also posted, if you don't mind, just rating our experience or your experience, should I say, with us in this session. So there is a form for you to just complete it so that we can constantly improve and grow. And we also then created a link that is for the rest of the quarter of 2025 of all the upcoming sessions. So if you'd like to register early, you can go ahead and do that now. So thank you so much. Have a great day. And we look
Thanks.
forward to seeing you in spring. Yay.
That's everyone.
Please complete the survey, because if I don't do well in it, then Amy may not invite me back for another session. Thanks, everybody.
Thanks
Bye.
so much.
Thank you, everyone. Thank you, Rahil. It was very informative.
Thanks, everyone.